What is successful investing? And when are you really a good investor? That is a question I have been trying to answer for myself for 10 years. First on a very small scale when I was young, and now recently almost full-time. I do a lot of research on stocks, and the crucial question is, when are you really a good investor? And this is actually a very complex question. Many people do not want to hear that because they are looking for simple answers. My name is Jorik Vermeulen, owner of Happy Investors. We help people invest more profitably, with more confidence. Absolutely no influence or pointless research, but really just high quality. However, we are all still learners. And that is somewhat the problem with determining when someone is a good investor. And of course, there are only a few very well-known good investors, and we will talk about that shortly. And because there are so few, the answer to the complexity is also clear. It is particularly difficult to truly be a good investor. First of all, what is the definition of a good investor? A good investor is actually someone who consistently achieves above-average returns. And here we must be careful not to be fooled by randomness. In other words, a concept that Nassim Taleb explains in his book. If you have a limited source of data, you can quickly draw conclusions from it. And we, with our human brain, look at thinking, fast and slow, system 1 versus system 2. We want to quickly jump to conclusions. And when we see a certain data set, for example, Jorik from Happy Investors has had good results for 2 consecutive years, then a conclusion can be drawn like, hey, that is a good investor, especially if you see certain, similarities in each other. You are also inclined to believe that person because that person resembles you. And these are, of course, all psychological pitfalls that you encounter not only in the world of investing, but also in private life and in business life, as our brain is often a bit primitive with many pitfalls and biases. So when is a good investor? Actually, I believe you should follow and trust the proven investors. And those are, of course, the well-known investors who have been doing it for many years, 20, 30 years or longer. And think of Seth Klarman, Warren Buffett, of course, Joey Munger to a lesser extent, but also, for example, Peter Lynch. More on that shortly. And be very careful about whom you trust and whom you do not. That's why I always say in our videos that we also publish content, and content has a couple of things. I really do it because I enjoy it. I don't earn much money from it, but it is a form of promotion. We reach people and followers with it. People come to our website. We also have a booklet that I update every year on successful investing in stocks. And there, I try to summarize the most crucial lessons from various books. And you should think of the hundreds of books I read, but also about entrepreneurship, as I am an entrepreneur. And we try to provide value with that. However, when we make a video about 5 great stocks, I always say to do your own research because it is impossible to know all those companies when you produce so much content. So a good investor is actually someone who has a lot of knowledge about the subject and manages to achieve that consistently. But that is complex. Why? There is something called market efficiency. There is a theory, efficient market theory, which essentially states that the market is so efficient because everyone has access to the same information, and therefore the price of a stock is always fully reflected based on that information. In other words, you buy the stock and you cannot perform better or worse than the market. In other words, you always perform on average. Well, there are certainly indeed a number of investors who find that very humorous, but however you look at it, that theory is very much embedded in the finance world. And if you look at, for example, Robeco or Rabobank investors or investors in general, they heavily play into the efficient market theory. They assume that, yes, you can hardly beat the market. We use algorithms, and what they also want to do is keep you satisfied. They put in a lot of effort to bring you on as a client. You generate revenue, and then they simply try to keep you satisfied. And what you do, in order to keep yourself satisfied, is to achieve an acceptable return. Therefore, a large number of investment funds, more than 80%, do not perform better than average. Some even perform worse. And then the costs still have to be deducted from that. And there are only a few who perform much better. And that is because they have fully tailored their systematics, their investment methodology, to market efficiency. This means that their portfolios consist of at least 20 stocks, and they trade frequently. They do use algorithms to try to increase their chances of success. We also use that ourselves because when we establish it, we use factor analysis. That is really exactly the same as, for example, a Rabobank or another bank uses. It doesn't matter who, right? Abel Janan Bro or Global Hedge Funds or Global Hedge, they all use the same thing. And they are actually not really trying to beat the market. No. What they are trying to do is, in their eyes, to limit risk. What is, in their eyes, risk? In their eyes, risk is volatility. In other words, a fluctuation of a stock. But that is not risk. Real risk means how likely it is that I will lose my money if I make an investment in a company. That is real risk. And then, when you start thinking in those terms, risk takes on a whole different kind of definition. Now, market efficiency is true in many cases, so it does indeed exist, and in many cases it is even correct. Market efficiency actually comes down to a number of principles, and for that, I borrow an insight from a very smart investor, Howard Marks. He has a very nice little book. It's called The Most Important Thing. And somewhere on, let me see, page 11, he describes what market efficiency is. And the market is, in most cases, quite efficient when the asset, or the stock in this case as an example, is very popular and well known, having many followers. Secondly, the share is socially accepted, so it is not a taboo, it is not tobacco, it is not coal. Thirdly, the benefits of the share or company are easy to understand, and the information is accessible. If you have a combination of those four, the chances are high that the market is efficient. And then you should think of, for example, that this is of course related to another aspect of investing, which is psychology. Psychology is very important because the market moves in trends in people's state of mind. When there is a depression, there are many bargains, many cheaper stocks, even from great companies. But when everything is going great and everyone believes that the world is always getting better, overvalued stocks arise. So even a well-known asset can be overvalued at certain times, or at other times, be very undervalued. A good investor is essentially always a value investor. Value investing means, in principle, that you buy a share below its intrinsic value or another type of asset such as real estate. Real estate is easier to understand. You have been looking at funda for many years. In your area, you have a lot of knowledge about the matter. You are an expert in your city, in your surroundings. And every once in a while, you see a house for sale with a lot of patience, listed for 200,000, while you are almost certain that the property is worth 250,000 euros. In other words, the house is undervalued. You buy it below market price. And there can be various reasons for that. It doesn't matter. It is undervalued, the house, so you buy it at a lower price than what you could sell it for. And that is what value investors do. They are very patient, very patient. They stay within their specific niche of expertise. Then, every once in a while, a situation arises, for example, a company they understand very well. But, for some reason, a lot of bad news comes out in a short period, causing the stock price to plummet, plummet, plummet. Then, short sellers come in, meaning there is even more pressure on the stock price. And he descends to a very low point. And based on their intrinsic values, they determine that this has fallen so far. This company is significantly undervalued. And that means if I invest now, I am actually buying a euro for, say, 50 cents. You buy 1 euro for 50 cents, buying more for less, is investing. You buy below intrinsic value. And that is quite complex. Many people use the discounted cash flow methodology for that. Others use a shortcut, namely the PI ratio or price-earnings ratio. However, there are many disadvantages to this. The best way is indeed to break it down manually based on scenarios. For example, this company has now dropped to a certain level. I just mentioned that the market value has dropped to 200, and that is why I am making this video here. It is almost certain that the company is actually worth 250 million, so you are buying it below the price, just like with a real estate property that you find after years of searching. If you can buy below market value, you buy a share, also below market value. It's exactly the same. The only difference is that you are talking about shares instead of one real estate property. That is the only difference. Now that Howard Marks has some interesting natural aspects in his book, very interesting. But when we talk about market efficiency, a market is considered efficient if a stock is very well known and popular, if it is easy to understand, if it is socially accepted, and if the information is very accessible to everyone. If we invert that, or turn it around, something that Charlie Munger always says, who will be coming up shortly, then we can think about when the market is likely not efficient. And that is also what Howard Marks indicates in his book. He states that he focuses his energy primarily on the segment where the likelihood is high that the market is not efficient. That makes sense because why would you invest so much time and effort in researching companies that are likely to have a correct value most of the time? Meaning, they are not obviously undervalued or overvalued. If you turn that around, for example, you end up with very small companies. I personally find it very enjoyable to conduct research primarily on relatively small companies. You should think of small cap stocks, meaning smaller companies with a market value of around 200 million, 500 million, up to a maximum of actually 1 or 2 billion. It also has another advantage. Small companies can grow their revenue much more easily, and as a result, their stock price can grow exponentially more easily. However, smaller companies are often less well known. Another book, by Peter Lynch. It contains many interesting insights, especially for beginner investors. He describes that his favorite stocks are mainly boring companies, meaning dull businesses that no one is really interested in, yet they still indeed have high profitability. Actually, it's a different way of phrasing to increase the chances of finding potentially undervalued stocks. Because yes, the market hardly pays attention to them. No one makes much effort to understand the company. Another example is that the company may be somewhat larger, but particularly complex. That is why, for instance, Wernberg does not like to invest in technology companies. Because technology can be quickly replaced by other technology, such as disruptive innovation. A complex company, if you know it very well. Then it is easier for you to have more understanding of the additional matter than others. So essentially, what a value investor wants to create is an information edge, meaning an advantage where he has more knowledge about the matter than the market. But you can also have an advantage in your mindset, for example, by exclusively investing for the long term and having much more patience than the average market. Nowadays, the average duration for holding a stock is 9 months or shorter. In other words, people hold a share for a very short time. Suppose you invest in a company, you cannot precisely determine when there is a dip, but the company is in a downward trend. You have seen this based on my intrinsic value assessment. Can I buy this company below its intrinsic value, meaning I will likely be able to sell it for a profit, but you don't know exactly when? Then you need to have patience. Even if that stock still drops by 10, 20, or 30%, you need to be strong in your convictions. But you also have to be right, and the only way you can be right is if you know more than others. Another example of a well-regarded definition of value investing comes from Charlie Munger. In principle, he says that investing is about seeking a mispriced gamble. In other words, a bet that is incorrectly placed in the market where you have a much higher chance of success than a chance of loss. And value investing is knowing more than others about that mispriced gamble. That is his definition. And this is easier said than done because there is also a lot of psychology involved. You need to invest in companies that have been affected by external factors because otherwise they are likely to be market efficient. So you need to start investing in companies that are no longer popular, often because they have various problems. Even better, they are also taboo companies, for example, scandals that have occurred at a company. And then you often see that the number continues to decline due to short sellers or simply trend investors, short-term traders. Not only must you be able to hold on to that stock, even for perhaps 2 or 3 years, during which you may be in the red for a long time. Not only that, but you also need to be right in your investment thesis. In other words, you need to know much more about that company, and perhaps a bit more about the market than the average investor. So you understand, that's why value investing is so complex, because how often are you right compared to the entire market that sees it differently? Maybe once or twice in your life, well, that's great, it can happen. However, we are talking about the definition of what a good investor is. And a good investor consistently realizes higher returns than the general return over 20, 30, or 40 years. Yes, how likely is it that you or I will be continuously correct for such long periods, continuously better, more knowledgeable than the overall market, with countless very intelligent people all competing against each other? Because everyone wants to find the next big thing or an undervalued asset. In other words, that chance is very small. So for most investors, and by that I mean 95%, it is simply much smarter to invest in an ETF. A global ETF can yield an average return of about 7% per year. And if you have a little patience, you can occasionally buy more during major market corrections to slightly boost your returns. If you do that, great, because then you save a lot of time, a lot of energy, a lot of stress, and a lot of other things. There may be a few individuals watching this video who will become very good at investing, but investing can only be done if you put in a lot of time and energy. Therefore, you need to stay sharp in the niche. Also interesting is The Dando Investor by Monish Pabrai. In addition to value investing, he actually prefers to invest mainly in distressed businesses and distressed industries. In other words, an industry that has faced setbacks for many years, and then he is also keen to invest in a company within that sector or industry, which has also experienced many setbacks. So in other words, a company becomes super cheap. Very interesting. And in his book, Dando Investing, he explains various principles about how or what. He emphasizes that if you see a company with a PE ratio, a price-earnings ratio of 3, from time to time, it might be worth taking a look. However, you need to be careful not to fall into the trap of cyclical companies or those that are heading towards complete failure. So here too, if you do that and invest your time and energy in that market, you need to get to know that company very well. And even if the company may indeed be in a bad news situation and is starting to crumble, yes, then you just need to know that and you should stay away from it. It's actually that simple. So you can greatly increase your chances of success by looking in places where other people do not take the effort to do so. Then you need to do a lot of research. You also need to stay close to yourself in your core competencies or your circle of competence, what you are very good at, where you can also be smarter than other people. For example, having 30 years of experience within one industry. And when you have all that, you also have to dare to take a chance. Now, Warren Buffett is of course very well known. There are a lot of books about him. I only find The Snowball interesting because it is truly a biography, and yet I came across some new insights. What everyone generally knows about Warren Buffett is that he is primarily a value investor. In his earlier career, when he was still young, he primarily invested in sugar buds. These are actually companies that still have a last puff left in them. Today, the reference is to cigar butts and actually cigar ends. So what does he do? He invests in a company. That company is worth more on paper than the share itself. In its best days, those were private companies that were for sale for 100 million, but the working capital was above 100 million. So basically, if you were to take over that company entirely, you could just dissolve it and pull out 150 million from the cash. And the inventory and liquid assets were above 100 million. So actually, if you were to take over the business in such totality, you would buy it over, then you would own the business. Then you can unbind it and you get 150 million out of the cost. You get 150 million out of the cost. Those opportunities no longer exist, as the market has become much too efficient for that. So gradually, he has transitioned, with the help of Charlie Munger, to investing in companies that have high quality, strong management, and particularly a sustainable competitive advantage. This simply increases the chances of success as a long-term investor, and therefore you also need to time the market less in the short term. But Warren Buffett has never let go of the concept of margin of safety. Margin of safety essentially means that you build in a safety margin, which is also sometimes referred to as margin of error. You do a lot of research on such a company. It's a small company, it's not popular, it might even be a bit controversial, and it's also in an industry that is hated, I might add. You have done a lot of research on the company, you also have a great understanding of it, you know it better than most. You have also spoken to experts in this area. You have conducted very thorough research on the finances. You have now found a company that you can be very certain has a good chance of succeeding in achieving high returns with a relatively low risk of losing a lot of money. So you invest in that company, but you always want to build in a margin of safety. So in your scenarios, your worst case should actually come down to the fact that I am completely off with my research. And in the worst case, I can hardly lose any money, but in the best case, I might be able to double, triple, or quadruple my money. So this is very complex, and that's why there are very few really good investors. I don't count myself among them. I am still in training. I have been at it for 10 years now, but in the first years, as I mentioned, not full time. The last few years, yes, at least 20 to 30 hours a week. What I spend my time on, I also read a lot of books and such, which is necessary. But above all, you need to analyze a lot of companies. And it is very difficult because you have to be very patient. You need to stay within the sector you understand, within the areas of expertise you have. And as I already said, you need to do a lot of research on the companies themselves So this is all quite difficult. And there are also many psychological pitfalls as well as advantages, of course. So consistently good investors are those who achieve higher returns constantly, which is very difficult. I want to come back to this book on value investing and value investors and explain why. I really like the book Snowball. It is a very important point. It is a very important point in very good companies. American Express and Washington Post are two examples. They were strong companies with a competitive advantage, which reduced the risk of failure. This is also part of the built-in margin of safety. But these were well-known companies. For example, he bought American Express at a time when there was some sort of crisis happening. American Express could therefore be affected. He had spoken to many people, and in reality, it seemed that the situation was not as bad as expected. The stock had dropped significantly. Warren Buffett then bought in large quantities. However, the stock has continued to decline, just so you know, so his timing is not perfect either. What he then does with those companies has never been entirely clear to me, but he also actively participates in, for example, the board, the steering group, and the management, where he coaches them. He did this, for instance, with the Washington Post. And he brings his expertise to those companies to help them grow. So that is actually an extra edge he has, as he can steer them here and there to keep the companies on the right track. Actually, I find the principle very interesting, which is why I am also delving into the world of private equity, or simply put, investing in companies. Shares are naturally from companies, only grading over non-listed companies. In private equity, one of the principles is that you buy a company, but you use a lot of debt. Why would you do that? Because then you can maximize your return on investment, or rather, the return on your equity, since you can contribute relatively little money and actually buy a lot of money with the help of debt. But that is, of course, high risk. So the only way you can do that successfully is by knowing those companies very well. How can you know those companies very well? By researching thoroughly, you notice that when you apply the same principles in the world of stocks, it really leads to the financial statements, and continuing with that. And you can already notice that if you apply the same principles in the world of stocks, then you create a chance of success. But this takes a lot of time and energy. You also need to be able to do it. You need to have knowledge, not just about the investing principles. You also need to have an understanding of entrepreneurship. You must also have that intuition of the entrepreneur, and also what I already mentioned, the psychological factors. So there are many things to think about. But nobody likes to talk about this, and nobody wants to listen to it. I have no idea how long this video is now. And this is actually just the tip of the iceberg. Although I think that, even if it is not always a coherent story, most principles about value investing and good investing are indeed addressed in this video. And you can see that it is quite complex. What Warren Buffett did, for example, is that he bought those relatively well-known companies, but he only bought them at moments when they were really in deep trouble, or seemed to be getting there. And it is mainly about seeming to get there. So all sorts of news pile up, bad news, and the stock price plummets. And in times of crises, Warren Buffett invests money, and I think that this idea could be accessible to most people. Because he still invests in relatively well-known companies that have a strong competitive advantage in the long term. He just bought them at times when there was a significant crisis. So that's not really market timing, because you will naturally see when the market crashes. The only problem is that it doesn't happen often. So he has had enormous emotional discipline to wait for years, and also to ignore all the technology stocks during the dot-com crisis. In fact, he spoke out against those ridiculous high valuations, and waiting for the market to crash again to buy in fully. And because it is so complex, because you have to be so patient, because you need to do so much research and know those companies better than the rest, the selection of opportunities in your life is extremely small. I find this difficult myself as well, because I am someone who likes to take action, and buying a few is done quickly. You log into your investment platform, click, and you've bought. But the real trick lies in being super patient, investing much more effort and energy in certain companies within your circle of competence, and only buying when the price is truly interesting. And because there are so few opportunities in your entire life, you might have to wait 5 years before you see your chance. Because there are so few opportunities when such a chance arises, investors like Warren Buffett and others invest relatively large amounts, sometimes even up to 40% of their portfolio. That is something that investment funds and hedge funds never do, because they want to keep the client satisfied. And if you invest 40% of your money in a stock and you get it wrong, you naturally minimize your capital. This is also not something I would recommend for beginner investors. Monish Pabrai invests a maximum of 10% of his money in one stock. Monish Pabrai primarily holds shares in coal. So theoretically, he can have 10 different stocks. Currently, Monish Pabrai has shares in, for example, coal. That is already written off. But as I said, value investing can be found in sectors that are hated, controversial, or taboo. If there is one thing that is now taboo, it is high CO2 emissions, or coal and lignite. And those companies are relatively cheap at the moment, but you have to be willing to do it. So that's also the ethical aspect to consider. But these people, even the smartest investors, do not invest all their money in one stock. And you step into it, you need to have a good understanding of what exactly the value is of what you are buying. I don't have it anymore. I sold it in 2021, but you're not going to tell me that you can value a crypto coin. That's really pure bullshit. So, I have to be careful with my words, but crypto or whatever, that's not value investing. Value investing means you buy a certain asset, you sell a certain cryptocurrency, and you sell for less than it is actually worth. This can be seen in stocks or in real estate. And those principles, such as actively contributing, which I mentioned earlier, can also be applied by yourself. You can do this, for example, by investing in a small business in your area and actively working on it yourself. But you can also buy a house that is already undervalued in the market and actively increase its market value through renovations. That is also an active contribution, and that active contribution actually increases your chances of success and reduces risk. However, everything depends on having very good analysis and understanding of the matter. I feel like I have been telling a long story about what makes a good investor, about the principles of value investing, and I undoubtedly still have a lot to learn myself. But after a lot of research, I think this is a good summary of where I stand today in terms of knowledge, and I hope that those principles of yours have been clearly communicated